Hi there, welcome to the week ahead with Alpha Wave Trader. This week we are continuing to follow this S&P 500 because it has been such an interesting case study, and I've been talking about this price action for quite a while now, about a month leading up into this, and I think it's worth following along as it develops, just to give you a good sense of some of the theory. And so you can keep an eye over the next week on the key points as this sell-off develops. And so I thought I'd kick off with a very big picture overview for people who are maybe new to this way of looking at markets. It's just going to give you a good overall sense of why I look at the markets in this way, and hopefully, it'll help you to unravel what I'm talking about as I discuss things in future. So this is the E-mini S&P 500 on a semi-annual basis. And a key part of what I do is look across different time scales and understand what the state of play is in those time scales based on what's going on with the buy and sell pivots. And to give you the quick reminder of what pivots are, what the buy and sell pivots are, as we've got a sell-off developing, and this is the crash from 2000 to 2003, you can see that there's new lows being created, and also the close of each bar. You can see the close of that bar below the low of that bar here. And so I'm actually looking at those candles as well as being important as the sell-off develops. Now, once you're looking for something to be turning around, obviously prices can't rally a long way until you've actually had a close, above the high of the lowest price candle. So if we're constantly looking at this sell-off developing, we're watching the high of these candles here, waiting for confirmation that potentially things are turning back up. Because really the rally can't happen until you've got one of those pivots, whether a buy or a sell pivot. Now, people will say on a 10-minute chart, sell and buy pivots are everywhere, and that's true. So the noisiness of them is something that makes them not as valuable as you go down the time scales. But my contention is that on the right time scale and in the right area, based on the waves that are being created and the ranges that are developing, you can increase your strike rate on trades by combining the area where markets often change direction with a theory on how they change direction. Now, looking at a large enough time scale, you'll see why these buy and sell pivots can be very handy. This is going back to 1997. Remember, this is a semi-annual chart, so every single bar is 6 months trading in the E-mini S&P 500 futures. So it's a long time. The time scale is very, very long term. But just very interesting to note, and these diamonds here, the black diamonds referring to the sell pivots, and the green diamonds referring to the buy pivots. If we follow along in 22 years of trading, basically the buy and sell pivots haven't made a mistake once. We've got the sell pivot here at the beginning of the sell-off into 2003. We've then got a buy pivot there at the beginning of the 03 to 07 rally. We then have the sell pivot leading into the 08 crash. We then have a buy pivot which is to close above the high of that lowest price candle. So there's your buy pivot, the fourth buy pivot, and we haven't had a sell pivot since. So ask yourself, would it have been handy back in 2009 to see this 6 monthly buy pivot and say, well, I'm now going to look at this market from a bullish perspective until I see the 6 monthly sell pivot. Quite clearly, it would have been very handy. And an added level of the theory is the concept of key bars within a rally. And the concept of the key bar is, once we have this buy pivot confirmed, the highest price close in the move, so of a candle, once it's closed, that bar becomes the key bar, and it has to close above the high of that bar to become a new key bar. So that means, as you follow the trend along and analyse what's going on, you are picking out a range, basically, that is the key range that you can make calculations of. So that would mean, if we follow this along quickly, we've got the buy pivot created, the next one closed back in the guts of that buy pivot candle, so that is not a key bar. The next one made a new closing high in the move, so that is a key bar. The next one was another new closing high, so that is a key bar. The next one didn't. It ended up closing back inside the range, so that's not a key bar. Also, the next one didn't create a new closing high. This next one did. And then you can see we've got the trend developing. We've got a whole row of new key bars in the rally. And then we have 1, 2, 3 bars that aren't key bars. And then we have, again, a rally beginning, and we've got new closing highs on these key bars. And then that isn't a key bar, and then that is. Now, how do these key bars help us? Well, you'll remember that I've spoken before, and if you haven't heard about this, this is absolutely crucial in how ranges develop in markets, and where the key areas are where you want to trade. So if I was to look at a distribution of prices, and the way this works, if we had a trend to the upside and then we got a big reaction, I then make a calculation off that range, and I analyse the price action that comes based on that initial wave to the downside. So that range, I then have a point of control of that range, which is the midpoint. That's where most of the trading occurs. It's a gravitational point around which the market will oscillate until it's ready to take off again. And the false breaks that we see of the range, where prices extend above and below the extremity of the range, that's where these false breaks occur, which tempt people into trades. So people who are bullish will be buying above the high, thinking it's a breakout. And then you have false breaks which head back to the point of control. And on the bottom side as well, you get the same thing, where you'll have people who bought in the range, in the guts of the range. They'll have their stop losses set up below the low of the range. Prices will go down, hit those stop losses, and once those stop losses are done, the buying pressure returns. prices go back into the range and head back to the point of control. And there are key areas within these ranges where prices also reverse course, and it's all based on calculations off the initial range. And that's where these buy and sell zones come in, where I'll look at the 75 to 87% area and that 25 to 12% area, which is where prices will often internally have reversals back to the point of control. Now, that's a very quick analysis for you. If you haven't been watching these, that might sound confusing, but it's going to make a lot of sense as we go along. Because as I look at these key bars in the range, in the trend, I will set up those ranges around that range on each key bar, and then I'll analyze from the key bar what the key points are, which is the point of control, that midpoint being important, the buy zone of the key bar, which is another very important, and also areas outside where false breaks often occur, and that is the 25% and the 618, which is the Fibonacci level outside the range. That is where false breaks will often occur to those extremity levels before having a false break and returning back to the point of control. So if, for example, we looked at one where that happened, you can see here we've got a new key bar in the range, and if we look at what happened, you can see that with this new key bar in this semi-annual rally, where did prices go to after? Well, you can see it got up to the 25% above before finding selling resistance, selling all the way off, all the way down to the 618 below, before reversing and turning back up again and creating a new key bar in the move. So even though prices sold off dramatically in that period last year, if you're looking at it from the point of view of these semi-annual key bars, you're actually looking at this sell-off into this area 25% to 618 below the key bar range as a potential buying opportunity. So the key bars are a really important way of being able to create calculations and levels and where buying and selling support should be, and to help to keep you out of trouble so that you're not buying at dangerous points. So it's all about trying to find a good risk reward in your trades and knowing where the buying and selling pressures are above and below the market, and using these pivots and also the concept of the key bars in trends allows for the development of trading strategy. So if we then, and I've spoken for quite a while on this, I think it was an important thing to take you through for people who are maybe new to these concepts. And if we look at the current situation in the S&P then, and we look right now where we're at, we have the semi-annual is still pointing up, which we've just been discussing. We've also got the quarterly charts are still pointing up for the US. If we look at the quarterly chart here, it's actually just had a quarterly buy pivot last quarter. So until we get a quarterly sell pivot, the quarterly charts are still pointing up in the US. But in the shorter term, we've actually had a sell pivot. And this is an important point for why I've been looking at the market as a short-term sell. You'll see here on the monthly chart that we've had a new high in the move. We've then had a close below the low of the highest candle. So that is a monthly sell pivot there. So I am looking for opportunities once that sell pivot occurs to enter a trade. And if we then go into the weekly chart, the weekly is actually still pointing up. So this is where I've been saying it's still early days in this move to the downside, but we're starting to see the signs we want. And last week I was saying the daily sell pivot was in place, and I was saying that it was a sell, and that was when prices were above 3,000. But if we go into the weekly, you'll see that we need to see a weekly close below the low of that highest price candle, and that low is 29.57 and a quarter in the E-mini S&P 500. So a weekly close below 29.57 is quite big, and we'll see a real shift in momentum to the downside. And late last week it was below that level, but then got bought into the close and closed above 57. So the weekly sell pivot wasn't confirmed. And the other key thing, and this is why I'm trying to set you up for the fact that the real momentum shift to the downside hasn't happened yet, but it's getting quite close. And the main thing to focus on in that regard is something I've been talking about in the past videos, which you can find if you go and have a look, is that I was looking for the potential of an ABC sell. And the way I analyze that, and this is the daily chart now. So we had the initial wave to the downside, which you can see. We then had a reaction and a sell-off, which hasn't broken below that lowest level. And then we've had the reaction to the upside up into the sell zone area of this whole wave down. Then if we get overlap, so if it fails back below the high of the A leg, so to just make it very clear for you, in analysing the potential of an ABC structure, I'm looking at this initial wave down as the initial wave. Then we have the reaction, which is the A leg, sell-off, and then the C leg. And so that is looking at here, we've got the A leg reaction, the B leg down, the C leg going up but not going higher than this high of the whole wave. Then if that fails back below that high at A, that's when you can get a real momentum shift to the downside and the selling will return. So that's sort of how it's looking right now, is that we've got the initial signs of the selling being present where we wanted to see it, and analysing the key bars on the daily, you'll see we've got the initial daily sell pivot, which I was talking about last Monday, which is that bar there. So then we have the new key bar down is on the daily close below the low of that candle. So there we have a key bar down, and that is still the key bar in this move. And that's one of the key things to learn, which is most interesting about this way of analysing markets, is until we get the close below the low of this key bar down. So that was the most recent key bar down, the lowest closing price and that it needs to close below the low of that candle to create the new key bar. So I can analyze the price action that's happening now based on that key bar, which means I'm, interested as prices head up into this sort of sell zone and even 25% above. I mean, I'm quite interested in looking for opportunities to sell. And if we get the buy pivot from here on the daily, then I can start considering what I need to do, and that would be a close above 29.93. So if we did see that, then in the short term we might be in for a bit more sideways price action. But until that happens, things are shaping up quite nicely, that we can get a continuation to the downside, and the momentum is going to shift in a much sharper way if prices do head back down below that low from last week, which is also, the high of that initial move, which is that ABC. So there's some dominoes lined up beneath here that can see prices really shift to the downside quite sharply. We're not quite there yet. It hasn't done it yet, but everything is now nicely set up, and there should be pretty strong selling pressure up around 3,000 to 3,020 in this market. So it's all lined up, and all we have to do is follow along with these pivots and allow them to unfold, and that's why this way of analysing markets can be so useful, because you get information very quickly, and so you're rarely hanging around in bad positions for too long. It'll be interesting to see whether this market can actually crack below that 29.45 area in the S&P this week, and if it does, it'll be a bit of a sharp sell-off on the cards. All right, cheers. Well, that's been a very long one today. I just thought it would be a good idea for new people to see, and I'll come back with more next week.